we are the REIT that is best positioned to outperform as the recovery continues.
I'm here today with Jim Risoleo, President and CEO of Host Hotels and Resorts. What are some steps that Host took last year to improve its portfolio, and what are you seeing today in terms of results?
We were very, very pleased that we were able to get $1.6 billion deployed last year. The assets are all performing well ahead of our pro forma, and we didn't stop there. Additionally, we disposed of assets over the course of last year and into the early part of this year. Roughly $1.4 billion of hotels in the same vein. And this all has led to an improvement in the metrics of Host portfolio. So it's a continuation of a strategy that began in 2017 when I became CEO, with a quest to really elevate the EBITDA growth profile of Host. And we've made great progress. If you look at the pro forma 2019 results today versus what they were a few years back, we've improved our revenue per available room, or RevPAR, by 11%. Our total RevPAR, which includes out-of-room spend, by 17%. Our EBITDA per key by 25%. And our margins have improved by 190 basis points. So it's really transformational, and it's put us in the best position that we've ever been in.
Can you describe the extent of the operational recovery that you're seeing within the lodging industry?
It's been pretty incredible, actually. You know, whenever we were in the midst of the pandemic, folks were saying, oh, we're not going to get back to 2019 levels of RevPAR and EBITDA, some as far out as 2025. Now, I'm not going to predict today because I can't when that's going to happen, but I know it's going to be a lot sooner than 2025. And the recovery is being led by leisure across the industry, for Host in particular. And we have 16 resorts. Let me put a fine point on that for you. In the first quarter, we had 5 of our resort assets generate average daily rates in excess of $1,000. It's for the entire quarter. That's pretty incredible performance. And I think it surprised us. It continues to surprise our operators that we're able to push rate. But there has been such pent-up demand out there. And, you know, quite frankly, I don't know that you can say that for all the resorts in the country. But our assets are in such terrific physical condition, and they really are iconic and irreplaceable. It's an experience. So we hope we can continue to push rate going forward. Now, that said, we're also seeing a pickup in business transient group. And the segue from the leisure customer coming back to business transient and group coming back is very encouraging, because it's happening in markets like New York City. It's happening in San Francisco, in Washington, D.C., in Chicago. A lot of markets are seeing business transient come back, and actually leisure going back into those markets as well.
Earlier this year, Host announced a strategic partnership with Noble Investment Group. How does this fit within Host's broader strategy?
It gives Host the opportunity to do a couple things that we wouldn't do on our own balance sheet, that we can't do on our own balance sheet in one instance. Number one, it gives us the ability to invest in select serve assets without clouding the story of who we are. I mean, we are the premier lodging REIT. We own 78 hotels with 42,000 rooms today, all upper upscale and luxury properties. And we certainly didn't want to cloud that story with investing in select serve hotels, but we think it makes sense to invest in select serve, so we can do that through Noble, through the fund structure. We've committed $150 million of capital to the latest fundraise that Noble's out in the market with today. Secondly, it gives us the ability to develop a durable fee income stream. through the collection of asset management fees on the funds that are being raised. Today, we get 49% of all the asset management fees, and over time, we have the optionality to acquire up to 100% of Noble.